Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, October 20th, and in his latest Big Picture installment, Briefing.com CEO Dick Green discusses political considerations. In his piece, Dick points out that policies do matter. They matter more than which political party is in power. Nevertheless, there is obviously a correlation between parties and policies. There is also a correlation between stock market behavior and political parties. There are plenty of long-term studies which attempt to show how the stock market performs under presidents of the two parties. This is a mistake for two reasons. First, the president often sets policy far less than Congress. This was clearly evident in the first 2 years of the Clinton presidency compared to his final 6 years. Second, longer-term studies that tend to include the Depression and World War II include extraordinary circumstances that may not apply today. But taking a look at the data since the Kennedy administration suggests several conclusions. 1. The best recent years for the stock market were under split government. 2. The stock market did well when Republicans controlled government. 3. The stock market has a mixed record under Democratic control. 4. Perhaps most noteworthy, the stock market has reacted more to changes in Congress than in the presidency. The market has fared better under Republican Congress than a Democrat Congress. With regard to the final point, the stock market rally of the late 1990s started in earnest after the 1994 election and the shift of power to a Republican Congress in 1995. Similarly, under the current Bush administration, the stock market fared poorly the first 2 years, as the 2000 crash continued, then rallied as a Republican Congress reduced the dividend and capital gains tax rates, and fell the past 2 years after the election of a Democratic Congress. The stock market also rose out of a nearly 2-decade slumber starting in the early 1980s after the effective control of Congress by Republicans with the Reagan victory of 1980. So, what does it all mean? The data suggests that investors prefer governments that support investment. Lower taxes on investment activity do matter. The stock market's best years were in the early to mid-1980s, following the Reagan tax cuts, after the 1994 election, and after the Bush administration cut investment taxes in 2003. It is axiomatic in economics that higher taxes on any activity will lead to less of that activity than otherwise would have occurred. The converse is also true. The recent history of stock market changes suggests that policies over the next few years that raise income, dividend, and capital gains taxes will in themselves not provide a supportive environment for long-term stock market gains. To read Dick's article in its entirety, put your cursor on the Our View tab at the top of the page and select the Big Picture, which is the fourth page listed on the drop-down menu. I'm Pat O'Hare for Dick Green and Briefing.com. Thanks for listening.